Since its founding in 1792, what would eventually become the New York Stock Exchange has gone through some pretty significant changes over time. When we think about how the process of buying and selling equities has changed in the last 60 years or so, it would be correct to say that technology has played the biggest role in terms of changing how people invest. Long gone are the days when people would meet up in coffee shops to sell corporate bonds to each other, or you would buy a stake in a company from someone selling them on a street corner, which is something that actually used to happen. We now have ultra-fast computers that can provide information at the speed of light and can be delivered right into our pockets through our smartphones. But if you were to go back and study what it was like to be a stock market investor in the 1950s and 60s for the average person, you would realize that it's not just technology that's changed the investing landscape, but the very way people choose investments back then are in stark contrast to what most people do today. In some ways, investing is now a lot better, but as we'll also see, investing has also gotten a lot worse in certain areas over time as well. What most people today don't realize is that picking good investments in the 1950s really wasn't that difficult. Back in those times, if you would have invested in a solid household company like Johnson & Johnson, Procter & Gamble, or Coca-Cola, you were almost guaranteed to be set up for long-term financial success in the stock market. According to a research study that was conducted by Credit Suisse, the average lifespan of a publicly traded company in the 1950s was 60 years old. This means that whatever company you chose to invest in back then had a pretty good chance of being successful over the long term. An additional reason for this greater chance of success in the markets was because companies prioritized paying dividends back then. According to an article in the Wall Street Journal, you can see that historically it was easier to come across S&P 500 stocks that paid dividends, and very generous dividends at that. In the 50s, it wasn't unusual to see company stocks offering 5 and 6% dividend yields and even higher than that. Because of all of these high distributions, when looking at total returns, the 1950s was the best decade in recorded history to be in the market. According to Shiller S&P data, from 1950 to 1959, the average yearly return in the stock market during that time was 13.7% before dividends. But you'll also notice that with dividends being accounted for, the average yearly return during that period was 19.3%. As you can see here, no other decade saw returns that high, going all the way back to the 1880s. So during that period of time, when the average company was around for 60 plus years and both companies and investors prioritized high dividends, it was very difficult to fail as an investor. Let's now fast forward to the year 2019. Another study that was done by the Santa Fe Institute provided us with some updated metrics. According to their findings, the average lifespan of a publicly traded company in America had shrunk from 60 years to just 10 years. One of the reasons for this is because in this day and age, companies frequently merge with one another and are acquired by other companies. Companies today are also much more likely to take on a lot more risk. Many of us are probably familiar with zombie companies, which are corporations that'll exist for many, many years without producing a profit because large investment funds will keep providing them with the money they need to stay alive in the hopes of one day achieving profitability. It's a very risky bet, but if these companies can achieve profitability, then the returns can be massive. So with all this in mind, the average investor in the 1950s is pretty much unrecognizable by today's standards. Back then, you could basically just pick a random household name company to invest in, and there was a pretty good chance that it would at least be around for the next couple of decades. And so what we see today in the markets is a lot more speculation. If you were to spend time talking with millennial and Gen Z stock market investors, you would learn right away that the way these people pick investments are completely unlike the way that their fathers or their grandfathers would have invested in the markets. Because companies don't last as long and many don't prioritize issuing dividends like they used to, referring back to the Wall Street Journal article, people aren't holding equities as long as they did previously. In terms of how long the average person holds a stock, it peaked during the 50s. Back then, the average investor would hold onto a company for 8 years on average. And this made a lot of sense. Again, companies were more likely to stick around for the long term and they paid very handsome dividends. But now, as we can see, given how short the average lifespan of a company is and the lack of dividends, which is a big contributor to total return, most people hold companies for less than 1 year on average. Many people who are investing in the markets today are now engaging in either day trading or short-term trading, which involves holding onto an investment for no more than a couple of weeks to a month or two. Again, this way of investing is dramatically different than what it used to be. But what's really the main point in mentioning all of this? Given how short most companies survive and the increased volatility that exists in the markets today, there's really only one conclusion that can be made. Today, nearly everybody cares only about capital appreciation, about whether or not a stock or an ETF share price is rising over time. And if you're investing for capital appreciation, you're going to be forced to constantly trade in and out of investments. Investing in the stock market was never intended to be this way. The old saying, time in the market beats timing the market, has been proven true many times in various studies. You're much more likely to build wealth in the markets through buying an investment and being able to stick with it for a long period of time. People who are chasing the next hype stock and trying to time their buys and sells are much more likely to lose money or underperform significantly. The key to being successful is to hold investments that are solid, which is where I would argue that dividend investing is a strategy that's needed now more than ever. First, if a company is able to even pay dividends in the first place and not experience cuts, that's a sign that a company is strong, or at least they're more likely to be strong. No company is ever required to pay dividends, so if one does, it's a pretty good sign that they're probably doing pretty good. Buying dividend-paying holdings, reinvesting those dividends, and staying invested is one of the best ways to safely build wealth. Warren Buffett once said that if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Second, it's also been proven that dividends account for the vast majority of stock market returns over time. This chart by Hartford Funds is one of my favorite things to show in my videos. Between 1960 and 2023, you can see just how big of an impact dividends had on stock market returns. If you're the kind of investor who buys into stocks hoping for a brief rally because you think you found the next Nvidia, you're going to miss out on all the substantial gains that come from dividends. It's not even a close call here. There's no denying that dividends matter and are a huge part of an investment's return. If an investment pays dividends, you cannot just go off of a stock chart. You have to look at total return of a dividend-paying investment, which includes reinvesting those distributions. Companies that pay dividends are much more likely to survive for many years, including the alternative investments. When the market is down, you're still collecting dividends and you can opt to use your dividends to cover your lifestyle expenses. Although dividend investing isn't prioritized like it used to be, there's still so many great reasons to pursue investing for dividends. Most people do not want to be told that they aren't smart enough to time the markets consistently, but it's true. Rather than having to trade in and out of positions for the rest of your life, try considering a different strategy, one that involves less work and cash regularly being paid to you. But with that being said, thank you for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.